So last Friday, if you weren't on the beach, you might have noticed that chip stocks sold off pretty hard, which gave rise to an opportunity that some traders might not have recognized. I'm Seth Freudberg, the head trader of SMB Capital's options trading desk here in Manhattan. And the traders on our proprietary trading desk are always on the lookout for trading opportunities that lend themselves to the option strategies that they've been taught. In today's video, we're going to be learning a strategy that professional options traders employ that has a very high probability of success with sometimes spectacular results. So if that sounds like something you'd like to learn more about, then stick around because you're going to find this eye-opening. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. So I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Semiconductor stocks in general, and Micron technologies in particular, have been pretty much selling off all year, as you can see. And after Micron released its quarterly earnings report after the market closed last Thursday, in which they warned of softening demand and supply chain problems that will affect the chip industry going forward, and despite the fact that they actually beat their quarterly earnings estimate, the market was so spooked by its warnings about storm clouds on the horizon that the next day on July 1, Micron's stock sold off yet again, this time down to its 2022 low of 53.65. Now, when bearish moves like this happen, there's a particular option strategy that some traders begin to think about employing, which has some really interesting features that we'll share with you in a minute. Before we get into how that strategy works, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. All right, now in order to go over how the strategy involving Micron Technologies works, I wanted to make sure that you are clear on how equity options work. And I realize most of you probably know something about how options work, but just for a quick review, and this is going to be fast, what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of his stock he owns at the strike price of that put, again, regardless of what price the stock is trading. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market. Or conversely, on the put option side, if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put. In other words, he gets to sell them way above market in that case. So naturally, all other things being equal, when a stock price goes up, the call options for that stock will go up because that right naturally becomes more valuable to the buyer. And when a stock price goes down, a put option for that stock will go up because that right naturally becomes more valuable to the buyer. So those are the basics of call and put options. All right, so let's get back to earlier in the year when the first real sell-off of the year in chip stocks began, And as you can see on January 21st, Micron had dropped below 85 for the first time all year, closing at 81.93, down from over 98 just a few weeks earlier in the new year. And so just like what happened last week, Micron was sitting at its lows for the year in the afternoon on January 21st. So let's suppose that on that day, a trader were to take a look at the price chart of MU all the way back to the beginning of 2021. And as you can see, he would have observed that during that entire period of a little bit over a year, the lowest price that MU had fallen to was a little over 65. And so armed with that information on January 21st of this year, with MU trading at around 82, suppose that he pulled up a Micron options chain 4 months out for the options that expire on May 20th, and he were to go ahead and buy 50 of the 70 strike price puts, then sell 100 of the 65 puts, and then buy 50 of the 50 strike price puts. And when he structures a trade in this way, that is what options traders refer to as a put side broken wing butterfly. Now, let's first dig into the cash flow of this particular broken wing butterfly to see what's going on here. And as you can see, we've received a price of $2.32 for selling the 65 puts, which you multiply by 100 because each put option represents 100 shares of stock, and we sold 100 of them. So when you multiply it all together, you end up receiving positive cash flow of $23,200 for selling the 65 puts. And using that same kind of math, you'd end up paying $17,350 for the 70 puts and also paying $3,250 for the 50 puts, which netted all down results in positive cash flow of $2,600 for this 4-month trade, which would require a little over $47,000 in your account to execute. Now, let's move forward 4 months to about a week before these options expire. And as you can see, MU, along with the rest of the chip stocks, continued to sell off. And MU, which was trading at around 82 when we put the trade on 4 months earlier, has now dropped to around 67. Now let's analyze what effect that had on that broken wing butterfly trade that we had initiated in January. And as you can see, the 70 puts we bought had gone up and are now trading at $4.39 a piece because, like we explained before, with the stock now trading below its strike price, then an owner of those puts could sell their shares for 70 when the stock is trading closer to 67, and there's still 9 more days for the stock to sell off further. But that guy's shares are locked in at a price of 70 if he wants to sell them, so those puts are valuable. But the 65 options that we're short and the 50 options that we're long, those are still out of the money. In other words, below the stock's price. And so they may well expire worthless in 9 days, whereas the 70s are less likely to have no value when they expire. So you can see why the 65 and 50 options have lost so much value and are just going for $1.72 and 17 cents respectively, because the market just doesn't have a lot of time to give them value by pushing the stock price so far down that they will also have value on expiration day. So how does all this shake out as far as our trade profit? Well, let's take a look at that. And as you can see, we'll start the analysis by remembering we collected that $2,600 when we first put the trade on. And if we wanted to close the trade, we'd need to sell the 70 puts for which we would receive a total of $21,950. And similarly, we'd sell the 50 puts and cash those in for $850. But we'd also have to buy back the 65 puts, which would cost $17,200, way less than we sold them for, which is a good thing because we were short those, and to close the position, we've got to buy those back. And so adding the entire start to finish cash flow of the trade together, we end up with a trade profit of $8,200, which is more than 3 times the original credit of $2,600 that we received at the outset. One more important thing I'd like to bring out about broken wing butterflies like this one, where we receive a credit at the outset of the trade, I'd like you to think about what would have happened if the stock hadn't sold off that hard. For example, suppose the stock had closed at 70 exactly on the day these options expired. Well, it's pretty easy to calculate the result of that because all of the options expire worthless in that case, because no one is going to exercise their right to sell their shares at 70 if the stock is trading at 70 anyway, and they obviously aren't going to exercise their rights to sell their shares below market at 65 or 50. So all of the options expire worthless, resulting in the trader simply keeping that $2,600 that he collected when he initiated the trade. And so think about it. Really, at any price above 70, the trader makes decent money, and occasionally you'll get a sell-off like we did in this case where you can make a whole lot more than that we originally received, and that's why options traders think of this aspect of the broken wing butterfly as a kind of a lottery ticket, a bonus profit that you can make on occasion. All we needed was for the stock to close above 70, which was a 15% drop off the stock's price when we entered the trade. And if that were to occur, we were guaranteed to make at least the $2,600. Below that point, there's a lottery ticket potential, as we saw in this case. Although if the stock had dropped a lot further, then the trade can become a loss, of course. And so what I'd like you to take away from today's video is the fact that options traders have tools at their disposal that have really fascinating properties where over very wide price ranges, the traders will make a solid profit, and in certain cases, a really extraordinary profit potential exists, a kind of a lottery ticket that professional options traders understand how to employ at the right times to their advantage often. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it, and please don't forget to hit our subscribe button right now so that you don't miss any of our free training videos to help you to up your game as an options trader.